Good morning, everyone. I'm Stephen Knight. I'm a banking and finance partner based in Dentons Abu Dhabi office. I've been in the UAE since 2008, and my practice covers most areas of transactional finance, from general corporate finance to acquisition finance and project finance, as well as Islamic finance. I act for both banks as well as corporates to have a broad view of what's happening in the market. I'm here with my colleague, Adam Pearce. Adam is a banking and finance partner based in Dentons London office. He's our first ever knowledge management partner, and his role is exclusively to deliver knowledge management and training both internally and to clients externally, such as the importance of the role that we've attributed to it, that he's a partner. As such, Adam is our go-to person for all things LIBOR related. So if there's any difficulty, we're going to defer to him. Adam and I have been asked to give you all an update on the current state of play in relation no reason you should. By the end of 2021, LIBOR is set to continue to have a profound impact on the market. Understand the impact that's going to have future financing needs, as well as the ability to raise future financing in the future, wider impact on your business as a whole. Just some housekeeping. The question and answers, etc. Throughout the session, please feel free to ask any questions in the Q&A box, and we'll try answering those as we go along. And also, this session is being recorded, and a recording will be made available on the platform shortly after the session finishes. Adam, can you turn over? Okay, so this session, as I said, is a legal market update in relation to LIBOR transition. In the session, we're going to cover an overview of the recent developments affecting new transactions, both in the loans and the derivatives markets. And then we're also going to look at legacy LIBOR transactions, the legislative solutions that are available or being discussed, the protocols that are available, and where they don't work, the manual repapering exercises that a number of banks and participants are undergoing. Adam's going to look at all these in a relative amount of detail. And then at the end, I'll pick up again and discuss what options corporate treasuries can consider doing now in order to manage the risks to your business. It's worth saying at the outset that the Association of Corporate Treasurers have got their own guide to LIBOR transition. This is available on the website, and it's also available on the event platform. So a really helpful tool for corporate treasurers wanting to understand what we talk about today. It goes into much more detail to do today. And secondly, we've got our own Dentons Frequently Asked Questions guide. We're on our third iteration of this now, and we keep this updated as the market develops. That's available on our website and as well on the event platform. So that's the intro. So maybe I'll hand over to Adam to discuss and take us off.
Great, thanks, Stephen. Good morning, everyone. Yes, I'm going to start by summarising the key LIBOR transition developments this year affecting new finance transactions. And one important area is the development of published indexes and published rates that can be used to help make the process of calculating compounded risk-free rates simpler and more transparent. To provide a bit of context, it's been clear for a while now that regulators are steering the finance markets towards using compounded risk-free rates in place of LIBOR, and the preferred risk-free rates identified for each LIBOR currency are shown there on the screen. When the first few pilot RFR-based loans and bonds were completed around about the middle of last year, it was accepted that parties would need to include some pretty complicated formulas in their finance contracts to enable the calculation of interest based on compounded risk-free rates. And while the primary responsibility for making those calculations is generally on the lender or the agent side, this also does put an extra burden on borrowers who need to be able to check that the finance costs they're being asked to pay are correct. The ray of hope at the time was that the need for these to be calculated manually from a complex formula was likely to be a kind of an interim problem. Eventually, there'd be some kind of screen rate for each compounded risk-free rate so that parties could use that in a similar way to plucking LIBOR off a screen, as has been possible to date. As shown on the far right-hand column of the screen there, that has transpired for some, but not all LIBOR currencies. So the Federal Reserve started publishing look-back period averages for SOFR in March, whereas the Bank of England confirmed this summer that it would not be doing the same for SONIA. However, even where these rates are published, they're not necessarily going to be suitable to use as a screen rate in the same way that LIBOR has been. For example, the conventions used in most English law loan agreements are for interest periods to be 1 month, 3 months, 6 months, etc., which is not necessarily consistent with the 30, 90-day, 180-day compounded averages that are being published for SOFR at the moment. The second solution to avoid the need to manually calculate interest based on compounded rates from scratch are published indexes, and these work a little bit like a consumer price index and make it possible to calculate a compounded average rate over any given period with a fairly straightforward calculation by taking the index value on the first day of the period and the last day of the period and getting a rate from those two figures. The good news is that published index are now available for compounded SOFR, for SONIA and some other LIBOR currencies, as shown in the column second from the right. However, as we'll come on and see, the calculation methodologies that are now being favoured in the loan markets are not always necessarily consistent with using these published indexes. I'll come back to that in just a moment. Now, as I've said, regulators have been encouraging the use of compounded risk-free rates for most products that have used LIBOR to date. They have, though, acknowledged that there are some finance transactions for which they will not be appropriate. In particular, any finance transaction which requires a fixed financing cost to be determined at the outset of a period or even the whole transaction, such as, for example, Islamic finance. So when news of LIBOR's likely demise first spread, there was much interest in whether it would be possible to create forward-looking term rates based on risk-free rates, which operationally, in the context of a transaction, would work in a similar way to LIBOR. Regulators have, I think, purposely delayed the development and publication of forward-looking term rates for risk-free rates because they rely on fairly shallow derivative markets for the underlying data and so suffer from some of the same perceived disadvantages as LIBOR. At the moment, there still aren't published forward-looking RFR rates for the main LIBOR currencies, although indications are that they may well become available for dollars and sterling during the course of next year. I should just flag that I'm focusing here on LIBOR and LIBOR currencies. Just for completeness, I would flag that for IBORs local to your region, there are no official plans to discontinue these or to develop equivalent published risk-free rates, although I understand there are rumours that some of the local central banks are now considering this. Okay, I'm going to spend a few minutes now talking about how regulators in the UK have been trying to drive forward the transition away from LIBOR this year. These steps have very much been focusing on the sterling markets, which I appreciate some of you will have little involvement in. However, I think it's worth touching on this as steps being taken in the UK are having an impact on LIBOR LMA documentation and are therefore influencing English law finance documents generally, even for financings in US dollars and other currencies. At the beginning of this year, LIBOR was still very much the default option for floating rate loans, with just a few pilot transactions having used risk-free rates. So to try to move things on, in January, the Bank of England's working group on sterling risk-free rates published a roadmap to transition, which said that the issuance of all new sterling LIBOR-based cash products should stop by the end of Q3 2020, in other words, by now. That always looked a tall order for the loan markets. However, it did look as though transition away from LIBOR was starting to pick up a bit of momentum in the first couple of months of this year. Then COVID struck, and in the following 3 or 4 months, lenders and borrowers were generally too preoccupied dealing with that to add the complication of introducing new unfamiliar interest rate mechanics into their transactions. And the Sterling Working Group recognised this quite quickly, and in an update in April this year, pushed back that no new sterling LIBOR products deadline for loans to the end of Q1 next year, as shown by the red arrow on the screen there. It did so while reiterating that the central working assumption about LIBOR, which is that it will cease to be available at the end of next year, has not changed and will not change. While this gave an extra bit of breathing space in April, the Sterling Working Group did also introduce a couple of new interim milestones for the end of Q3 2020. So since the beginning of October, lenders that provide sterling loans need to be offering a non-LIBOR option, and any new sterling LIBOR loans that are written must contain contractual mechanics to facilitate conversion away from LIBOR by the end of this year. By the end of next year. So this is the regime we're currently in between now and the end of March next year. So let's just look in a bit more detail about the basis on which lenders are still able to provide LIBOR-based sterling loans during this interim period, and how that's having a knock-on effect on in loans in other currencies as well. What the Sterling Working Group said precisely was that after the end of Q3 2020, lenders working with their borrowers should include clear contractual arrangements in all new and refinanced LIBOR referencing loan products to facilitate conversion ahead of end 2021 to SONIA or other alternatives through one of two ways. First, by pre-agreed conversion terms, or secondly, by an agreed process for renegotiation. So pre-agreed conversion terms means that the document has all the usual LIBOR terms in it, which will apply to calculate the financing cost at the outset, but it will also have a full set of economically equivalent RFR-based terms in it, or some other alternative mechanism, which will apply at a later trigger point. So it's not all being left to be agreed at a later date. There are two basic ways in which pre-agreed conversion terms can be incorporated into a finance document. One is to build the RFR language into the usual fallback waterfall that applies if screen rate LIBOR is not available. So instead of just having fallbacks that cover interpolated screen rates, maybe reference bank rates, and then lenders' costs of funds, none of which are designed to cover permanent discontinuation, you stick a risk-free rate-based benchmark into the top of that fallback waterfall, and these so-called hardwired risk-free rate fallbacks have been recommended by the ARC for inclusion in US dollar LIBOR-based transactions, at least under New York law. And as we'll see, ISDA have been working on similar mechanisms for derivatives too. But hardwired fallbacks haven't really taken off in English law loan documents. The loan market seems to now be moving towards a slightly different approach, which involves hardwiring a specified switch date into the document. So the key difference is that even if screen rate LIBOR is still around on that switch date and no kind of discontinuation event has happened, the parties will still switch away from LIBOR on that date. So it's designed to just give a bit of operational breathing space for the parties to get ready to move, rather than it being a true fallback as such. The most high-profile early deal that included this mechanic was the Royal Dutch Shell syndicated RCF, which closed at the end of last year. And in September, the LMA produced a new multi-currency exposure draw facility agreement that included this type of switch mechanism. We've acted on a few of these recently in the UK, and it does seem as though it's starting to gain a bit of traction in the UK market, at least in relation to sterling loans, although I think that probably hasn't really taken off to quite the same extent in the Middle East so far. The Sterling Working Group has left open a simpler documentary option for new sterling LIBOR loans, which is that instead of setting out all the conversion terms up front, parties can just include an agreed process for renegotiation. Now, until the middle of this year, the only term in loan agreements commonly included to make it easier to amend LIBOR-related terms was the LMA's replacement of screen rate clause. And all that did was provide that amendments to LIBOR-related terms could be made by majority lender approval rather than requiring all lender approval. The working groups made clear that that is not an adequate agreed process for renegotiation. So in August this year, the LMA published a note with a suggested additional element to the clause, which says that if LIBOR is still being used to calculate interest under the agreement by a specified date at some point in 2021, all parties have an obligation to enter into negotiations in good faith on and from that date to amend the relevant terms. Now, we wouldn't see the inclusion of this as particularly problematic for a borrower. It's likely to be in everyone's interest to move away from LIBOR by the end of next year. For other LIBOR currencies, the position is not quite so prescriptive. So the time, looking at some of the other timetables, the ARRC in the States has set a target of no new US dollar LIBOR business loans after the end of Q2 next year. So a quarter later than the official the target set in the UK. And the Financial Stability Board, which is looking at this from a global perspective, published a global transition roadmap for LIBOR in October, looking across all currencies and all products. And it said in that parties should aim to use robust alternative reference rates to LIBOR in all new contracts where possible by mid-2021, so similar to the ARRC position. So the transition milestones are slightly more generous for non-sterling LIBOR products. However, if your lenders are continuing to offer fairly familiar looking LIBOR-based finance products at the moment, that's likely to change pretty soon. All the various oversight bodies are very consistent in emphasising that all institutions that still offer LIBOR products in any currencies need to start moving off them very quickly. Okay, so moving on to a couple of points. Oops. Oh, excuse me. There we go. Moving on to a couple of points around the methodologies that are used to calculate risk-free rates in the loan markets. Firstly, there are a couple of key parts of the methodology that have been pretty settled in the cash markets for some time. Firstly, interest rates over an interest period are calculated based on daily risk-free rates during an observation period, which starts and ends a specified number of business days before the interest period, usually 5 business days. So that's a kind of one sort of fairly standardized approach in terms of using risk-free rates. And a second area which has been established fairly early is that those daily rates are going to be compounded to take into account that risk-free rates represent an overnight cost of borrowing, but that interest on an RFR-based loan is only payable at the end of an interest period, usually of 1 or 3 months. One of the less settled elements today has been whether the look back should apply using the lag method or the observation shift method. And the loan markets have been going backwards and forth a little bit on this, as shown on the screen there. The earliest pilot loans used the lag method. Then there was the very high profile British American tobacco facility closed in March this year, which used the observation shift method. But then since then, the loan markets appear to be swinging back to the lag method. Both the Sterling Risk-Free Rate Working Group and the ARRC have recommended this for business loans on the basis that it's simpler. And that's now reflected in the most recent LMA exposure draft facility agreement. What practical difference does it make? Well, almost none to the amount of interest that a borrower has to pay at the end of an interest period. Indeed, unless there happens to be a public holiday in the part of the observation period that doesn't overlap with the interest period, or in the part of the interest period that doesn't overlap with the observation period, it won't make any difference at all. The main practical difference is that you can't use a published index or indeed any other sort of published rate when using the lag method, because you're having to input into the calculation information from outside the observation period, and this will vary depending on the specific terms in your contract, such as the length of the look back period and the business day conventions you're using. So as things stand at the moment, operationally, RFR-based financings are likely to be much more complex and involved than LIBOR, and it will be important for treasurers to get into the detail early with their lenders to understand how the calculations are going to be done, who's going to be doing them, and where when the information is going to be flowing between the parties. There's been one other significant change in methodology on the loan side this year, and that's around whether the compounding of risk-free rates is done on a cumulative or a non-cumulative basis. Until recently, the basic process of calculating RFR-based interest on a loan transaction was fairly settled. As shown in the diagram in the top half of the screen there, it involved a single calculation for each interest period, which would be done by the agent or the lender on a bilateral deal, and that would be done at the end of the observation period for that interest period, so a few days before the interest is due to be paid. So they would calculate the compounded average of the risk-free rate over that entire observation period, and that rate would apply over the whole interest period. So like a LIBOR loan, although the interest rate is floating, the same interest rate applies on each day throughout an interest period, and then it would be reset for the following interest period. The problem with this method of calculating interest is that if a loan is prepaid or a lender transfers its commitment in the middle of an interest period, it's not possible to work out how much interest has accrued during the interest period up to that event, that mid-interest period event. The parties don't know the interest rate that applies on any day in the interest period until that calculation is done at the end of the observation period, which is often, as I say, just a week before the end of the interest period. Now, there are some potential workarounds for that problem, but the Sterling Risk-Free Rate Working Group is now recommending a different calculation method to avoid it altogether, and this is known as non-cumulative compounding. So how does this compare to what I've just described? Well, a big difference is that with non-cumulative compounding, interest is calculated afresh every business day during the interest period. So you have a genuinely floating rate product where the interest is going up and down throughout the interest period as the risk-free rate fluctuates during the linked observation period. However, despite this, the amount of interest that accrues over a whole interest period will be exactly the same as it would have been under the first method, the cumulative method, provided the same rounding conventions are used. So this non-cumulative method is essentially reverse engineering a different kind of method of calculation to get to the same end result, but providing for daily accrual of interest. How do you actually calculate a non-compounded daily rate? Well, I put an illustration on the screen there, but partly in the interests of time and perhaps for your own sanity, I'm not going to walk through each step of the process now. There are full details in both the Dentons and the ACT notes that Stephen mentioned at the beginning, so do have a read of those if you want to get to the bottom of non-cumulative compounding. The relevance of this new methodology is shown by the fact that the LMA has now followed the Sterling Working Group's recommendations and is using non-cumulative compounding in the latest LMA exposure draft facility agreement, and that's not just for sterling, that's for all LIBOR currencies, including US dollars. It is just an exposure draft, and we know that some of our UK bank clients prefer cumulative compounding, so they've already sort of set their systems in place for that. So there may well be some further twists and turns yet. I suppose the basic takeaway point on this is that RFR-based pricing is complicated, and in some instances we anticipate that treasurers may prefer a simpler option. It's still early days, but in the UK we've been instructed on a couple of central bank base rate loans this year that in the past would have probably used LIBOR to calculate interest. Now, a very quick update on ISDA and derivatives. Much of ISDA's work over the last couple of years has been focusing on incorporating risk-free rate-based fallbacks into the IBOR definitions in the ISDA definition schedule. The basic idea being that if LIBOR does disappear, any reference to LIBOR in a derivative transaction will automatically be replaced by an economically equivalent rate that's based on a risk-free rate, and ISDA has now completed that work. That's the kind of the key development over the last few weeks. Earlier this month, It published its fallback supplement, and that amends the definitions of LIBOR and other IBORs in derivative transactions dated on or after 25th of January 2021. Under these amended definitions, if there's an index cessation effective date, references to LIBOR will be automatically replaced with a reference to a compounded risk-free rate plus a credit spread. And that credit spread is calculated based on the historical difference between LIBOR and the relevant risk-free rate as calculated and published by Bloomberg. So the basic idea of this is to avoid the need to manually amend derivatives contracts to remove LIBOR references. However, as we'll see in just a moment, for existing LIBOR referencing derivatives that are used to hedge interest rate risk, it's unlikely to be possible to avoid manual repapering. Okay, now much more briefly, I'm just going to touch on a few points around legacy transactions and then hand over to Stephen to talk around some of the practical points that, that you should be looking to consider at the moment. What I really just wanted to flag are that there are, I suppose there are sort of three potential ways in which legacy LIBOR transactions can be addressed and moved away from LIBOR. One of those is to consider is to rely on a legislative solution. So for there to be some kind of change in law that means that rather than parties having to manually amend their products, it's all done for them through the operation of law. I won't go into the detail on this other than to say that there are legislative solution proposals in place in the US, the UK and the EU now. All of them have overlapping scopes. None of them are in final form yet. However, the basic point of all of these is that they're all focused and likely to be limited in scope to dealing with what regulators call tough legacy contracts. So those are contracts which the regulators accept it's not practical to amend any other way. And so a typical example of that would be a New York law bond, where this type of amendment would typically require 100% bondholder consent, which is unlikely to be practical to achieve. And so there may be a legislative solution for those types of contracts, but for parties who have existing LIBOR-based loans and other general finance contracts, it's unlikely that the law is going to come to the rescue to amend those. There is the option in the derivative space to use a protocol, which ISDA has developed alongside the fallbacks supplement that I mentioned earlier. And that enables parties to sign up to a protocol, and that will automatically then amend any of that party's existing derivative transactions that party has entered into with any other party that has signed up to the protocol. However, this is unlikely to be an option for dealing with hedging products, and the reason for that is that loan agreements are likely to be need to be amended manually and are likely to be subject to active conversion ahead of LIBOR actually being discontinued, and for that reason, hedging is likely to need to be amended at the same time and in the same way as the product that it is hedging, to avoid any misalignment between the main financing product and the hedging product. So for standalone derivatives, the protocol may be a useful tool, but it's unlikely to be a full solution for finance-linked hedging. So the reality is that huge volumes of existing LIBOR contracts will need to be manually amended between now and the end of next year. And that is going to be the case both for the vast majority of cash products and for finance links derivatives. In the main, we expect this to be a bank-led project. We're currently assisting a couple of banks with their repapering projects, and we're aware that many other banks have been working on these for some time. So in the loan market, certainly it's going to be lenders that are generally going to be driving that process rather than something that borrowers should be primarily responsible for instigating. We anticipate that it's likely to be Q2 next year before we really start to see large number of repapering projects fully activated, I think most lenders are looking to ensure that the new market for risk-free rate-based lending starts to bed down, so that there's a bit of more clarity about what you're amending LIBOR away from, to avoid too much negotiation at that point. So primarily a lender-led process. However, that doesn't mean you shouldn't be engaging with your lenders and other funders now about their repapering plans. I'm going to hand over to Stephen to talk a bit more about some points you should be thinking about now.
Thanks, Alan. So the starting point is that you have a significant influence in the process, which is being led really by the regulatory response to LIBOR. So for a large part, we followers, you're going to be following the banks and the banks lead. As Adam said, we're working with a number of banks in the UK, or UK regulated banks, which have put in place procedures on starting to look at policies and what they're going to do in relation to the LIBOR discontinuation risk. I think it's fair to say that most regional banks are not developed in their processes as the UK regulated banks, both from a driving perspective from the UK regulator. It's not quite strong here in the Middle East. Just to put that into context, we're still seeing LIBOR-linked term sheets for new transactions, even for long-term dated loan agreements. So that sort of gives you an idea as to where we are in the Middle East in terms of readiness for LIBOR discontinuation. Treasury is and we know which market is heading. We know LIBOR is going to be discontinued as to what transactions have closed and likely how it's going to be, interest is going to be calculated. And so, yes, there's a risk that will change, as we've seen, as Adam saw. There's a risk that will change, but those risks are going to be around the margins rather than the substantive need to be done. This is more than just a paper exercise. There's systems in place. Your systems, how you calculate interest, how you payment systems work. All of those things are going to need to be looked at in order to understand the risk. And as corporate treasurers, you've got an intrinsic role in your institutions to be able to drive that change forward. On the slide is an extract from ACT's guide to LIBOR. It's basically a really simple checklist, easy to understand, and just says that a few points that you should be looking at. And we really would endorse all of this. One thing that you can do is identify those LIBOR exposures you have now. One hopes, as a corporate treasurer, you've got a good idea as to the number of loan agreements you've got outstanding, what the term is, the tenor, whether they're LIBOR linked or not, what currency is. So one hopes that's not too much of an exercise. It just may be a bit more difficult to piece them together when you've got significant numbers of contracts which have slightly different ways of calculating LIBOR with different currencies. But just literally understanding that is a really important point. One part that we haven't really talked about are those non-financial contracts, which the bank's not going to lead on at all with you, unless they're probably in some finance-related transaction where the banks are taking a risk on the underlying economics. But generally, as a business, you do want to be looking at those non-financial contracts that have LIBOR, so reviewing those contracts to understand what those contracts are, the quantum, the nature. Is it just about how you calculate default interest following a non-payment, and how important those contracts are if you fail to fall under them to your wider business? That's going to be really important to understand. The second point in the list is understanding the alternative rates. Again, we're not going to go into this in detail, but the ACT guide and also our frequently asked questions go into this in significant detail. So we recommend that you immerse yourself in those and understand how they're calculated. And keep on top of market developments. We can have these sorts of seminars or webinars where we can tell you what's happened, but also just understanding what happens on a daily basis by signing up to the ACT newsletters, the LMA's newsletters. And I think I can say that there's probably at least one email every day one email every week from the LMA about what's happening in LIBOR. So really understanding what's happening in the market will help you understand the nature of the risk that your business is going to encounter, and the mitigants that are currently in place. Engaging with counterparties, we really can't emphasise this enough. This is a bank-led process, but it's probably not going to be sufficient to wait until the banks come to you and say, we want to renegotiate the contract. You really do need to have understood what your risk is to LIBOR and how your systems are currently anticipating the transition from LIBOR to the new risk-free rates. So engaging with counterparties in the bank, understanding what their timetable is, and then building your project plan and timeline around that so that you can be prepared to engage quickly and efficiently and with as little disruption as possible to your business, because fundamentally you are there to make money and you want to be focusing on doing that and your business on the Is that better? Yes. So what did you miss?
You're okay to keep going, Stephen. It was a bit crackly. But...
Okay. So yeah, we say engage with counterparties and make sure that you understand the timetable that the banks have for your financial transactions, and make sure that you're in a position to respond to it effectively and efficiently. And then there's the final 2 points, which are definitely within the realm of control of the corporate treasurer, which is your own internal systems and infrastructure. You know, how do you calculate interest? What's your exposure on a daily basis? What are you going to do in your financial reporting when the interest period extends beyond your financial quarter or your reporting period? How are you going to be able to calculate that and report accurately based on, as Adam was explaining, the non-cumulative risk, non-compounded rates? So all of those things are really important. So we would just say, look at these things, engage with counterparties, engage with your auditors, and consider the tax and accounting implications as a result. Adam, do you want to go to the next slide? So on new finance transactions, I mean, this is one which is, if your systems are in place, relatively easy to look at because you're starting afresh. It's not as difficult as the legacy contracts, but you could start with a risk-free rate now as the benchmark. This is relatively uncommon in the Middle East. There's still limited take-up for non-sterling loans. We are aware of one facility, which is the GlaxoSmithKline facility, had a US dollar $2.5 billion facility and a 1.9 billion sterling facility, which was calculated exclusively by risk-free rates. That followed the ARCC and the Sterling Committee's recommendations and the methodology. And so it didn't go to the switch mechanism, which you see in the LMA, went straight to risk-free rates. And that was financed by 12 international banks, which was had HSBC as the coordinator for risk-free rates. So you can see that new role developing in the banking community, about the bank that's going to take the role of making sure all the banks can lend on a risk-free rate basis. The other two, the middle two, are less well seen here in the Middle East. The hardwire with a switch, starting with a switch happening on a specified date and agreed spread, don't really see in the Middle East markets, although there is increasing take-up in the European markets. And then you've also got the hardwired with a fallback, which effectively is linked to discontinuation. Again, we don't really see that in the Middle East. There's very little hard-coded reference rates in facility agreements. What we tend to see at the moment, and as I said, most of the contracts that we've seen or term sheets still include LIBOR-based interest, has a DLMA replacement screen rate clause, which is this obligation to renegotiate that Adam was talking about. And then Adam, excellent. And then on legacy transactions, as we said, I mean, the option here is not to wait, and so not to wait to see whether IBOR disappears. It is going to disappear, so you need to make sure that your systems are in place, and you look at those legacy contracts to understand what the risks are. And as I said, it's most likely that you're going to have to wait until the banks approach you. But as we say, understanding what they are and what the timetable is going to be really important for you. So we definitely recommend on the legacy contracts to do this third option. It's unlikely that you're going to have the ability to amend now yourself, to a risk-free rate, although if there are amendments and restatements of facility agreements or other material amendments, there may be a window which actually makes it possible, but that's really opportunistic as opposed to trying to deal with it in a methodical and consistent way. So I think that brings us to, I think we're conscious of time, so that brings us to the end of the session. I don't know whether we've got time for any Q&A, but I'd like to thank you all anyway for joining this presentation and watching it. It is available again on demand, and hopefully you'll be able to pick up the parts that you may have missed of what I said at the beginning, hopefully. It'll be available on the platform for the next 30 days, so please feel free to watch again. If there are any questions you have, please feel free to drop Adam or myself a line. Our details are on the screen. Continue the discussion on the chat function or in the networking lounge on the platform, or pay a visit to the virtual exhibition hall. Finally, there's a session survey which is on the Q&A box, so please feel free to give us the feedback on that. And I guess next up is a spotlight on Saudi Arabia, so please do join us on the ACT for that session and also the rest of the sessions later on today. Thank you very much, everybody.
Thank you.